Hello, everyone. Welcome to our brief overview of stockholders' equity. As the slide shows, we'll cover the stock hierarchy, paid-in capital, treasury stock, earned capital, dividends, whether they're cash or stock splits, and then finally the statement of stockholders' equity and the presentation of stockholders' equity on the balance sheet itself. So let's begin with the stock hierarchy. These four terms create a logical progression that every business student should understand. Authorized shares represent the maximum number of shares a company is legally permitted to issue according to its corporate charter. Think of this as the company's share capacity. Issued shares are those actually sold to investors, the shares that have moved from the company to shareholders' hands. Outstanding shares are the issued shares currently held by investors. This is the number that matters for dividends and voting rights. Then there's treasury stock. Treasury stock represents company shares that have been repurchased. These shares are issued but not outstanding. They're sitting in the company's treasury, hence the name. The key relationship here is that outstanding stock equals issued shares minus treasury stock. When it comes to stock issuances, companies will issue common stock and may issue preferred stock. Notice the distinction between preferred and common stock. Preferred stock has fixed dividends and priority when it comes to dividends and liquidation, but typically have no voting rights. Common stockholders get variable or no dividends, but enjoy voting rights and the potential for unlimited upside if the company is doing well. Now that you understand the different types of stock companies can issue, let's explore how these stock transactions are actually recorded. Whether you are issuing common or preferred shares, the accounting mechanics follow the same fundamental principles. Three terms that we need to know right from the get-go are par value, no par value, and additional paid-in capital. Par value is a nominal amount assigned to each share. It's often just pennies or $1. Par value is purely an accounting convention and has nothing to do with the market value. Some states require par value as a legal minimum, while no par stock has no assigned value. When it comes to additional paid-in capital, or APIC, we're talking about something that captures the premium investors pay above the par value. When someone buys stock for $15 per share with a $1 par value, the extra $14 flows into additional paid-in capital. The formula is straightforward. APIC equals the issued price per share minus the par value per share times the shares issued. So how do share issuances affect the company? Well, cash increases by the number of shares issued times the price per share. Common stock increases by the shares issued times the par value per share. And additional paid-in capital increases by the difference between the cash received and the amount allocated to common stock. Now let's turn our attention to treasury stock. Companies repurchase their own shares for several strategic reasons. Returning excess cash to shareholders, signaling management's confidence in the company's future, increasing earnings per share for the remaining shareholders, or taking advantage of what they believe is an undervalued stock price. We record treasury stock at cost as a contra equity account, reducing total stockholders' equity. When companies buy back shares, this reduces shares outstanding. Remember our hierarchy. Outstanding stock equals issued shares minus treasury stock. Companies can later resell their treasury stock, usually at current market prices. When selling treasury stock, companies cannot recognize gains or losses on these transactions. They don't appear on the income statement. However, when treasury stock is sold for more or less than its cost, the difference goes to additional paid-in capital or retained earnings, staying within stockholders' equity accounts. When treasury stock is resold, shares outstanding increases again. The key insight here is that treasury stock transactions directly affect shares outstanding, which impacts voting control and dividend distributions to the remaining shareholders. The center of the slide focuses on retained earnings, the earned capital of the company. This represents the company's accumulated profits minus all dividends paid since the company was formed. The retained earnings equation is fundamental. You take the beginning balance plus net income minus dividends, and you'll get your ending balance. This account bridges your income statement to your statement of stockholders' equity and to the balance sheet, showing how profitable operations build permanent capital. Unlike paid-in capital, which comes from investor contributions, earned capital comes from the company's own success in generating profits and retaining them for future growth. Now let's turn our attention to the sections on cash dividends, and stock splits. Cash dividends involve real money flowing to shareholders, and timing matters. 3 critical dates govern the process. The declaration date creates a legal liability. Once the board of directors declares the dividend, the company now owes money to shareholders. The record date determines who gets the dividend. You must own stock on this date to receive payment. And then finally, the payment date is when cash actually changes hands. Remember that cash dividends reduce both retained earnings and cash, as wealth flows from the company to its owners. Let's turn our attention to stock dividends and stock splits. When companies declare a stock dividend, they're distributing additional shares of stock to shareholders. The dividend is expressed as a percentage. For example, a 10% stock dividend. No cash changes hands. Shareholders receive more shares, but each share is worth proportionately less. The total value of shareholders remains the same, but they own more shares of the company. Stock dividends can be either small or large. Small stock dividends are under 25% and use the market price to transfer money from retained earnings to common stock and the additional paid-in capital account. An example would be a 10% stock dividend on 100,000 shares, resulting in 10,000 new shares issued. If the current market price is $25 per share, retained earnings will decrease by $250,000 with an increase in common stock and additional paid-in capital of $250,000. All changes take place in the stockholders' equity accounts. Large stock dividends are 25% or more and still require journal entries. But in this case, they use par value instead of the market price, we transfer money from retained earnings to common stock based on par value of the additional shares issued. Like small stock dividends, this rearranges stockholders' equity without changing the total stockholders' equity amount. Like a large stock dividend, stock splits increase the number of shares outstanding by issuing additional shares to current shareholders, while proportionately reducing the price per share. Unlike stock dividends, stock splits reduce the par value per share and do not require a journal entry. The 2-for-1 stock split is the most common. If before the split you own 100 shares at $80 per share, after the split you will own 200 shares at $40 per share. The total value of your investment remains at $8,000. Stock splits are essentially a cosmetic change that makes shares more accessible without affecting the fundamental value of your investment in the company. It's now time to examine the financial statement that ties everything together. The statement of stockholders' equity shows how each equity component changed during the period. Starting with our beginning balances, we can trace every transaction's impact. The stock issuance increases both common stock and additional paid-in capital. Net income flows into retained earnings. Dividends reduce retained earnings. Treasury stock purchases create that contra equity account. Notice how each row represents a different economic event, and each column shows that event's impact on a specific equity component. The beauty of this statement is that it provides a complete audit trail of how ownership changes during the period. Finally, our balance sheet presentation shows how stockholders' equity appears to external users. Common stock and additional paid-in capital are listed first, followed by retained earnings. Treasury stock appears as a reduction to total equity. The total of $109,550 represents the book value of shareholders' ownership in the company, the residual claim after all liabilities are satisfied. This basic overview shows how stockholders' equity transactions are interconnected. Share issuances build paid-in capital. Profitable operations build retained earnings. Stock buybacks return capital while reducing outstanding shares. And dividends, they distribute earnings. As we work through this chapter, we'll explore each of these concepts in detail, learning to record transactions, prepare statements, and analyze the story that the stockholders' equity tells about a company's financing and performance. Remember, stockholders' equity isn't just about mechanics. It's about understanding how companies finance themselves, reward their investors, and build value over time. These concepts form the foundation for analyzing any corporation's financial position and performance. Thank you for taking time to watch this video. Good luck with your studies.